Welcome to the Gray Report. So much macro data was just released this week with the big story with the Federal Reserve Federal Open Market Committee having announced a 25 basis point rate cut to the Fed funds rate, but so much more has come out from unemployment numbers to consumer sentiment to so much more. So we want to get into all of those kind of macro data dumps that have just happened this week, try to break it down, what that means for the economy, but specifically what that means for multifamily commercial real estate, how to make sense of it, how to make sense of investing in this type of environment. Also, a piece from Redfin talking about new apartments are increasingly likely to get snapped up quickly as construction slows, and then a handful of new reports related to single-family homes in the housing market. Housing market is definitely slowing down. It's not throwing out absolute red flags or warning signs, but definitely some declines year over year. So a lot to talk about, a lot to digest. Fortunately, new special guest host is here today on the Gray Report. Addison Lubert, who is our chief, he's our main analyst. He's underwriting all the great capital deals, figuring it out, helping us out on asset management. He sees so many deals, underwrites so many opportunities. He's seen a lot more deals than I've seen over the last year because I'm running around doing a lot of other things. Going to get his take on the multifamily market, how these new reports might influence how we're looking at multifamily investing going forward. And I've got a lot of questions to ask him about, what he sees as a good deal, some deals maybe we've passed on that might have turned out to be good deals, how he sees underwriting, and what's changed, especially working with sellers and brokers from 2025, 2024, 2023. Things have changed a lot over the last few years. I want to hear from him exactly what that's looked like. So if you are an active investor, passive investor, anywhere in the middle, maybe you're just in the multifamily industry, you're in the right spot. Every single week, we are breaking down all the latest research reports, articles, insights related to the multifamily industry, commercial real estate, and the macro economy. So strap in, subscribe to the Great Capital YouTube channel. This is going to be a good one. Let's get into it. Welcome back to the Gray Report. Addison Lubert joining us once again. Addison, welcome to the Gray Report. Thanks for coming on today.
Glad to be here. Thanks for having me.
Absolutely. I think this is the first time. This is not your first time on the Gray Report. I think is it the first time that you've been on with just me though? Second time?
Yeah.
God. Well, welcome back once again. I think this is our. We don't actually do like an episode count. We need to do it. But I think we're over 200 episodes now. So it's probably been a year, 2 years since you've been on with me?
Before Thanksgiving of 22.
Okay.
Of 2022.
Yeah. Time flies. Mm-hmm. Man, time flies. Well, I want to jump right into this piece from Redfin. New apartments are increasingly likely to get snapped up as quickly as construction slows. According to the piece, 48% of apartments built in the first quarter of 2025 were rented within 3 months, up from 47% in Q4 of 2024 and 46% in Q3 of 2024. They're basically implying here that there's an increased leasing velocity over the last few years. The market seems relatively slow right now because we're absorbing a lot of these units. Some properties, talking to owners, seem like they're taking longer to lease up. But, according to this Redfin data, it looks like there's actually been, again, increased velocity of leasing up. When you looked at a lot of deals last couple of years that are like properties in lease up, mm-hmm. That where a broker or an owner will come to you and say, hey, we'd love for you guys to take a look at it. Often we're trying to buy more stabilized properties that have already been leased up. Mm-hmm. But, if they're getting close, it'd be something that we're interested in. Does this new report from Redfin jive with what you're seeing, maybe anecdotally, but on the ground? Does it seem like new apartments are able to lease up at even a faster pace compared to a few years ago?
I feel like from my vantage point, I typically, when it comes to like this type of property or in this type of situation, I'm either getting it in the early portions of a lease up where the developer, or in this case, the seller, has experience or is willing to do the lease up, but definitely would not hate it if somebody else took care of that.
Someone came in and just took their problem or property off their hands, they'd be happy.
Right. So I'm either seeing it in that stage, or I'm seeing it in it's either recently completed or you would be putting on just kind of the finishing touches of the lease up. So it can be hard to get a sense of, really that the leasing activity and how it went, unless it's one of those, unless you're really kind of tracking the timeline. And if the lease up went well, brokers are usually very happy to tell you the lease up went well and it went quick, and just keep you up to date on that. So where I really try and look at is really just what's the situation that they're in terms of what's their concession load?
Yeah, that's what I was going to ask you about. What kind of concessions are you seeing on some of these newer builds right now?
Any combination of maybe the first month or so free, or a pretty hefty gift card, or some combination of, I'd say either one of those two, and then more often than not, I would say waived, application and admin fees. I don't have a feel for which of those gets more attention from renters, but that's typically what I'll see, and that seems to be one of those is pretty standard. I think any sort of variation from those is either they're really in the early stage and they don't want to waste any time, or things might not have been going well and they need to pick it up so they can end the process.
Well, a lot of times it's because with interest rates having increased over the last several years, their interest carry cost, the amount of money that they have to bring on to pay the interest payments, they don't have rents coming in to pay that. That's maybe doubled or tripled what they thought it was going to be. If they're still looking back at a pro forma from pre 2022, which there's going to be less and less of that as we go on. So developments that are probably breaking ground today, they're assuming a higher rate. But if it's something that was delivered within the last year or two, that maybe took a couple of years to actually build, that original pro forma may have been built in the low rate days. Are you seeing, I guess, not just concessions, but actually like decreasing rents to get that lease up done sooner as well? Or are they trying to keep it all below that revenue line and keep it at concessions?
More often than not, I think it's shown in concessions, because when you're offering concessions, you're able to tell people, I'm fetching really high rents.
Yeah, it doesn't really impact the rent roll as much.
And so when you convey to the next to the buyer that there's a lot of opportunity here, you can push rents. Look at where our rents already are. You can easily explain away a 1 month concession to get somebody in, or some waived fees, and that makes things look better. And it's also gives you an opportunity to tell people that, who knows, in 12 months from now, when most of these expirations are happening, could be a completely different market. Even though it's not likely going to be the case, there's a push there versus we are below market rents and we have to be below market rents. And there definitely is upside, but I can't tell you when. The concessions can kind of mask that. So more often than not, I think concessions tends to be the more, I guess, common item. But I also think there are a lot of there's a good chunk of deals that I've seen where if it's a larger group and they're trying to recycle capital through their funds, and it's just sort of we're selling because we needed to sell in year 5 and we told everybody. That's where the rent roll can get a little interesting, because it's not, especially from our perspective, we've never thought of just selling a property on a whim. It's a plan, and we've always had those discussions have happened quite a ways out. Those rent rolls can be pretty interesting because you want to push, you want to show that there's upside, but you also don't want to be giving somebody a property with 10% vacancy.
Yeah.
So that's where your rent rolls can get a little, I don't want to say out of whack, but just you start to see some things that are not entirely normal, you kind of have to dig a little deeper, and then that's when you're kind of moving around comps, and then also trying to figure out like what was their strategy here.
Yeah. Yeah. And sometimes there wasn't a strategy. Sometimes there
Yes,
very
that
clearly
too.
was. Sometimes they've been working on getting the property ready to sell for the last year or more than that. Whether it's cutting expenses to get, the T12 to be as attractive as possible, getting that NOI number to be attractive so they can get, a cap rate that looks like it makes sense to the buyer.
Yeah.
Or just, it's massaging that rent roll. And there are tricks that kind of everybody does, the current industry standard of, all right, we'll capitalize a little bit more. Then there's some things that can be a little less above board of that some owners or even some brokers might try to pull. What's the most egregious that you've seen?
The most egregious that I've seen was a deal, 2023 construction in the Midwest, and some combination of, I shouldn't say some combination, it was a botched lease up. And I don't know if that was they didn't set their rents or their expectations coming out of construction at the levels that they should have. I don't know if it was just that they hired the wrong management group to handle that initial stage, but it was a long lease up that was not, just was not going well. And we had seen it in 2023 come on the market, saw it again in 2024, didn't trade, and then got a notification from the broker that had listed it twice before that just said it's the bank's taking it and it's being listed by this other group as a receivership sale. Looking at the concessions there after the bank took over, it was a lot of it was the nightmare concession scenario where they were recurring concessions of $200-$300 a month off, or you maybe have $100 a month off and then no pet fees, and then just all sorts of recurring concessions that you are getting to a point of, okay, what are we in for at takeover, or what would we be in for the first year of the hold period? Because it doesn't really matter what the rest of the market looks like on a rent growth or on an occupancy standpoint when, just to get people to pay what they should be paying on rent, the contract rent without the concessions means that there's $300 a month that they were having off that they now have to account for. And how many of those people decide, how many of them just leave? Yeah.
Yeah.
Because when you give them that kind of concession, like I can easily see why somebody would move for a year or however long to make that work. And then they reevaluate their options and realize, well, I can move somewhere else that's going to be $100-$200 less than what you're offering.
Well, and it can be dangerous from the operator, because even if they decide to renew, you're not always, maybe re-qualifying them at their higher amount. So maybe they say that they can pay it, but maybe they actually can't, or maybe that's putting them into a truly, rent burden situation of where some emergency expense pops up and they can't pay rent, and so you've turns into delinquency, or in worst case scenario even an eviction.
Yeah.
And all to solve for a little bit of occupancy ends up costing you a lot more than maybe a month of vacancy would have costed.
So I would say that's the most. I don't think I've ever seen a concession schedule like that, and that was from our standpoint. Forget if there's opportunities for rent growth. Even to forecast a standard 2 to 3% seemed a bit overconfident, just because it's like if somebody's getting $300-$400 a month off already, I don't see how we'd be able to go above that contract lease rent.
Yeah.
Unless they just really love living there. And given the situation that property was in, I could be wrong, but I would not be surprised if the management situation wasn't great.
And so a bunch of concessions can act as like a fly in the ointment. What are some other things you might see on a T12 or a rent roll from an underwriting standpoint, an eventual ownership and operation standpoint, that when you see it you're just like, oh, come on guys, like really did you have to do this?
So I don't always know if it's a line item or anything that would frustrate me as much as it is when you start to see waived. If you see normal rent concessions, that's one thing, and for the most part you expect to see that. It's then once you get into kind of the total other income where they've then you're seeing waived pet fees or waive application fees or waive. And so when you start seeing more of it, I think it's not always a problem, but it's more of a like, okay, if this was in the, months 1 through 3, and they were maybe tossing something to get somebody to rent in a leasing or part of the leasing cycle, otherwise people wouldn't. Ideally, we would not want to do that, but I get it. But if you see the more consistent fees, that's when it's like, okay, what's really going? Like, how strong is this 95% occupancy really?
Exactly, it's death by 1,000 cuts, and so someone may say, hey, well, we're now 95% occupied, or we're increasing rents by 7%, 8%, 9%, but it's like that rent increase is with a concession or you're waiving fees, and so it's really not as full rent increase as you thought it was. Or it's like, yeah, you've got that occupancy, but you've got a couple $100 of loss to lease to get that lease, and you could argue from a strategic standpoint that's worth it. That you want the heads in the beds, you want some revenue coming in than nothing. But it's frustrating from our standpoint when it gets turned around and spun from the seller or the broker as like this great thing. And it's like, yeah, okay, you solved one problem, but you've created another problem by doing that.
So I would say those are always concerning, and then kind of your non-variable other income numbers, like if there's ever a high or a consistent lease termination fee, the bigger the property, and also it can be market dependent. If it's a big property in an area where, we've looked at, I could think of several deals that we've looked at where people are like, they don't really move into another apartment, they buy a house. Yeah. So some of those you can explain away, but when you see $100,000 in lease termination fees,
how often can that keep happening?
Yeah.
What's going on, and that just doesn't seem sustainable.
Right.
Unless it is a very unique situation of where everyone that's building a house or everyone that's renovating a house, everybody lives here. 20% of the residents are just in the middle of a home renovation project, and they're going to move out, and maybe it's going to get done early. We had a property up in Granger, Indiana, South Bend that has been like that. There's been periods, especially like during COVID, where it's like so many people here are building a home, and they thought it was going to take a year, and it ends up taking 2 years. But then when it's done, they're ready to move in, they might be fine doing a lease cancel. They're going to just break their lease. They want to get out of it, and they're happy to pay the fee.
Yeah, and I think, it speaks to just being flexible from our standpoint in underwriting, but also how we are internally with just property management. I remember taking I think it was the first time I'd ever been up to Villas on Fur, and when we were walking with the property manager, and they explained how many people will rent a unit for 4 to 6, be interested in a 4 to 6 month lease, and it was for no other reason than they live in Los Angeles, they fly in the fall to go to Notre Dame football games. Yeah. And they'd rather go this route than the hotel because consistently they'd use it, and they're interested in doing that, and then they're fine. And then when we toured,
we just signed another lease like that, I think yesterday. I think it was for $3,300 a month for a 3-bedroom, but about villas. Yeah, I don't know if I have to see if it's that for that reason, but.
And when we looked at a deal in Lafayette, they're like, yeah, you wouldn't be surprised how many people either rent homes for that reason or they're intrigued for Purdue football.
It makes sense. It's a lot cheaper than buying a condo or something, or buying a house just to be up there for games. If you're going to every game, but you don't need to go hang out in South Bend or wherever year round. Not a bad option. Obviously, apartment operators, us included, charge premiums for shorter term leases because we got to turn the unit. If you're only going to be there for 3 months, we still have to put all the costs in to turn the unit and release it. But it can be a win-win. We get a little bit extra income. You get a place for cheaper than a hotel. It can work out.
Yeah. So I think just seeing more deals over time, those are, every once in a while I'll just see something on the rent roll or the T12 of nothing that's like, why'd you do that? Well, I could say, why'd you do that? Why'd you do that in the sense of like, okay, what was the logic behind this? But not like whoa. Mm-hmm. You've really set us back, or you're really setting yourself back doing this, aside from that concession thing. But that was, that was a deal that was going to or the bank owned it anyway. So that was kind of the least of their worries.
Well, I want to talk to you a bit more about underwriting, but I want to get through these other news articles. This next one is a piece from Realtor.com. Stymied sellers back down as home prices drop for the first time since spring. And we've got a couple pieces that are similar that were out on the Gray Report this morning, which the Gray Report it's the best multifamily newsletter on the market. GrayCapitalLLC.com/newsletter. You can sign up for it. And man, again, this edition was packed so full of reports. Not as many multifamily reports, just because we had a ton on the newsletter last week, and there just weren't that many new ones over the last week. But so much macro data. A handful of articles all about single-family homes, and the consensus was, I think 3 out of the 4 articles was that obviously single-family home market is slowing down. It's by no means crashing, but it is down marginally on a national level, year over year by around kind of a percentage point, plus or minus, in terms of housing costs. That lines up with some of the demand that we're seeing in the multifamily space. Obviously, a lot of supply in multifamily and single-family homes. But another report from the Mortgage Bankers Association that came out over this last week showed that mortgage applications are up because long-term rates are down. Mortgage rates are kind of at a multi-year low. Now we're finally, I think it's like low 6s, high 5s, which high for someone that bought a house a couple of years ago. But if you've been in the market looking, I think there's a good amount of pent-up demand just because some people certainly are continuing to buy, but there's a lot of people who are just, it's not an option right now. They want to wait for rates to come down. You're kind of at the age, Addison, where I don't know if you're thinking about buying a home or if you're like, that's in the future, but curious your thoughts on the single family home market, kind of where it's going and kind of the current state. And then when are you going to buy a home, if ever?
Not
to put you on the spot.
I think of the single family home market in ways that I think it ties into the multifamily market, and I to a degree almost feel like the broader economic landscape of really ever since inflation peaked or we had that huge run up in the rate increases. I feel like a lot of people were making so many decisions based on, okay, well, this is a temporary thing. When things readjust, we'll buy the house or we'll sell the house or we'll do whatever. And at least with conversations that I've had with brokers, it seems like we're now kind of reaching the point of people getting comfortable with this is the reality.
Yeah, especially in the multifamily side.
And, from an interest rate environment, I don't want to say it can only get better, but I'm wondering if people are starting to just have that, well, okay, it's going to be in the 5s or 6s. And if people are thinking, okay, within the next year, flash forward to mid-September of 26, do we really think it's going to be in the 2s or 3s like it was in COVID, like for COVID times?
Yeah.
That I'm thinking, I wonder just how many people have kind of, it's not necessarily a situation of certainty, but people have just realized that this is the environment that we're in. It's likely going to be this way, and they're ready to they're now finally ready to buy the house, or they're now committed to, okay, we're not going to get the high price that we thought. Let's sell this and move on. So I really wonder if that's what's going on. And I feel like there's been enough tidbits throughout just conversations with people in my personal circle and with realtors to think that they're not realtors, with multifamily brokers, that I just think across the board people are kind of settling in as just this is what our reality is. But with that being said, I don't in terms of long-term fundamentals with multifamily, like I still think housing affordability is going to be out of reach for a lot of people, and I don't think that a small basis point drop in rates is going to change that for a lot of folks. I think there's still going to be plenty of renters for necessity.
Yeah, no, I think it's a good point. I mean, I think the people who are taking advantage of, slightly lower rates, relative to a couple of weeks ago, are the people who they clearly can already afford to buy the home. They have the down payment. That really hasn't changed much. It's just, they're just what they're comfortable with their monthly, mortgage payment and trying to see if we can lock in a lower rate. And I think there's a lot of people who, again, can't afford it, but are telling themselves, well, I want to wait till rates come down, and they're waiting and waiting and waiting, and they're getting impatient, and so they see rates. And again, there's nothing really to do with it's related, but not directly related to the Fed funds rate. The longer term rates had been coming down over the last really kind of month and a half or so, in a big way. That's lowered those mortgage rates. The idea that maybe they'll slip down a little bit, but they haven't moved much really since yesterday's announcement. But I'm curious in your conversations with your friends, cohorts, kind of a similar age, what is the conversation around buying a home? Is it an option? Is it on the agenda at some point? Is it just kind of like a dream, or is it like no, just a matter of time? But just gotta have to save up the down payment or figure the down payment out. Or are you guys like, we're never buying a home, we're gonna rent, and that's all right?
I would say, at least with friends in Indianapolis, they're in a much different and much more favorable situation from the home buying experience or perspective than I would say friends that I went to college with that are in Columbus, Ohio, or any of my friends I have growing up in the Chicago area. For the people growing up in the Chicago area, it's not to say that they don't have any interest in owning a home, but for them, most realistically for them, to buy a home is when they move back to the suburbs, and they're just not at that stage yet where they're going to move out of the city and go back to the suburbs, unless they just really want to, or their job makes that kind of necessary.
They want the flexibility. And, they're not ready to settle down.
Indianapolis, and it's true for Columbus, but I just personally don't know of anybody that's gone into to buy a house yet in Columbus. But in Indianapolis, there's the added benefit of just how it's not as dense of a city in the sense that you can buy a
house in the not downtown, but you can buy a house in the city.
Yeah.
You
can be 15 minutes away from downtown and have a house that has a front and backyard. You can have a pool in the backyard. There's not too many big cities that you can say that. So I think it's a combination of just it's accessible. I know of some people that it's been kind of the house hacking. One person's had the money and wanted to buy the house, and they have roommates that are gonna make that happen. And I think it's also a little bit of I've done the apartment experience, and because I've had a roommate for so long, I've been able to save up for the down payment, and I'm ready for this. So
you were in an apartment for multiple years, and now you're living in a house, a rental house, right? How's that? So were you at that point of where you were like, all right, I've been in an apartment for a couple of years, I'm ready for, I want that single family home experience. It's a little bit more space. Or what was the drive to go to a single family rental versus an apartment?
I think, it was a combination of just not necessarily having to pay as much in rent by splitting it was an attractive option.
So you can split it more now because you have more roommates, or you're splitting it less because you have...
Well, before it was just me. Now I have roommates. So having that cost burden or not having it was a major advantage. It's one of those things that I kind of made that decision, and then after I made the decision to stop living where I was at, all the cons that I kind of thought about but didn't really bother me started to really ramp up of I can only exit the building one way to then go across the street to get in the parking garage, which you can only get in one way, to then walk all the way up to get to your car and then do that. It's a 10, 15 minute ordeal just to get to your car, whereas now I can just walk outside. So some of those things. But no, I can't really say there was anything about the apartment experience that I was ready to get out of or anything. It was more so just kind of personal circumstance. But it definitely was nice to, if you had a maintenance issue, to go on an app and someone could take care of it versus we'll get to it when we get to it.
Yeah.
But it also has been nice of being in a home to have an idea to a degree of how home maintenance works when it's not entirely your responsibility. And so you can sort of figure out like what could go wrong. How do you fix it? How does this,
especially if like I would absolutely be fully responsible for fixing everything if it was mine. And so that has, and we hear about this a lot, and we talk about it sometimes internally on the operations side, is that, single family rentals, the expectation for service is less so than an apartment building. And I know sometimes our facilities and maintenance teams and the office teams can get frustrated because some residents are like, this needs to be resolved today. And they're not always like emergencies, and they're not always the biggest, the leaky faucet. It's like, we're going to get to it, but like if somebody's AC is out and somebody's door is falling up, there may be other priorities. Someone's moving in tomorrow.
Yeah.
It's like, can we get to your leaky faucet tomorrow? Now in a single family home, single family rental, you may not ever let them know about the leaky faucet. What's the difference, I guess, do they make that expectation known and clear that, hey, look, call us for important stuff. Don't call us to change a light bulb. Don't call us for, minor issues. Not to tell you to repair it yourself, but I guess what was the different dynamic in the conversation between the single family rental that you're in now versus being in the apartment where go on the app, hit a button, and somebody's going to show up that day, hopefully?
I mean, they for the most part spelled out kind of like what's your responsibility and what's not. But there's also not an easily accessible, I guess, like there's not.
It's a more of a process.
Living at the apartment complex that I was in, you knew that there were maintenance guys that were here every day, or I shouldn't say every day, but they had a maintenance shop. They're around. They're supposed to be here.
Yeah.
Whereas there's somebody in our landlord's network that comes out to fix stuff, but you don't know what he's doing that day and if he's even able to respond.
Yeah.
So for stuff like a light bulb or
you don't want to bother them. I wouldn't want to bother them.
Changing the air filters, would I like to have to pay for any of this stuff? No, but it's quicker for me to just go to Lowe's and get a new air filter and replace it myself.
Do they charge you for maintenance stuff?
Somebody cuts the grass. They charge us for that.
They do charge you for cutting the grass.
Yeah.
Yeah. Okay. Well,
but I mean, we did have a moment where the washing machine, one of the cords that connects to the pump was snipped, cut. I don't know what was going on, but they're like, see if you can try and fix it yourself. And then I was like, you've got a wire cut, and this isn't
electrician.
Yeah, and they're like, well, how did that happen? And I was like, I don't know, but also you did say to try and fix this ourselves. We're going through that process. You don't have a washing machine. Can we just sort this out?
Yeah.
A lot of that stuff. So
yeah, a lot of back and forth. Now, you're dealing with the property management company or the landlord directly?
No, landlord. I don't think there is a company.
Fun. Well,
it'd be a lot easier if it was a company.
You would think I mean, some things yes, some things maybe not. All right. Well, that's fascinating. So get back to the question. I haven't got an answer from it yet. You're gonna buy a home at some point, or is there a desire to buy a home at some point? Or just if it happens,
kind of
great.
I mean, kind of an if it happens. I mean, overall, aside from maintenance, the actual renting a home experience hasn't been bad. For me personally, the buying a home is one of those things of I don't really want to buy property unless I plan to be there for a while.
Yeah.
That I would like to hold off the first big house purchase for that reason.
Yeah, I think that's smart. Looking at this is a piece, National Association of Home Builders and Wells Fargo. They have a housing market index. Did a survey, and the way they do it, I'll just read the description. It's designed to gauge and track the pulse of the single-family housing market. It's a monthly survey, and they ask single-family builders, about present sales of new single-family homes, about expected sales of single-family homes for the next 6 months, and then the traffic of prospective buyers of new single-family homes. And then it's on a scale from 0 to 100. A higher reading, greater than 50, is an indication that the majority of builders feel confident about the current and near-term outlook for housing. Low readings signify less optimism among builders. Current sales conditions held steady at 34, so that's not good, or it's less than 50. Net sales expectations in the next 6 months rose to 45, so still negative, but trending in the right direction. Traffic is pretty abysmal, and that's traffic at multifamily has also been down. And so, again, just less demand for housing. I think it's uncertainty, which we'll talk about as the University of Michigan sentiment survey was also released, that we're going to talk about. But, man, this looking at this chart, October 23 to September 25, I mean, we've been basically kind of at the lowest point in terms of this HMI, single family housing survey, over the last two years. So not fun if you're a home builder. And again, I think a lot of this is driven by its interest rates, clearly, its affordability, and its uncertainty. People don't want to make big financial decisions when, I don't know, it's a confusing world out there. Mm-hmm. Just hold it off for a little bit longer, just kind of maintain the course. Are you ready to switch gears, talk about some macro econ?
I am, yeah.
Okay. Such a, what a big day yesterday. That really didn't move the needle that much. And of course, we're talking about the Federal Reserve, the Federal Open Market Committee came out and gave us, they released their summary of economic projections, the SEP. They also came out and announced a 25 basis point rate cut to the Fed funds rate, factoring lowering that shortest term rate. That will also should lower SOFR as well, the secured overnight financing rate that a lot of floating rate loans are tied to. So this will be an immediate benefit to borrowers that are using floating rate loans, floating rate debt.
They could use some help.
Some of them certainly could. Now, again, the question is, 25 basis points really enough relief, though? Is that really going to help some? I guess, we'll take it if what we can get. But they also said the Federal Reserve, the plan is basically 3 25 basis cuts at the next 3 meetings, 25, 25, 25, come down to full 75 basis points. And then they're going to be data dependent. They're going to take each meeting one at a time, but that's the plan right now. When we read through the summary of economic projections, really what they're forecasting is pretty smooth, soft landing narrative of inflation as they measure it, which we don't think they're really measuring it correctly, by the way. But the way that they're measuring it is that we're basically at 3% inflation today, which isn't really the case. But they're at 3% inflation today. They're going to get down to 2% by 2028, and they're comfortable with that glide path. Just not next year, not the following year, but in 2028 will be at 2% inflation. And they have GDP, changes in real GDP, basically in a very tight range, really of all the opinions, kind of really never exceeding 3% and kind of being at call it 1.8 to a mid to high 2s all the way through 2028. And they're putting the longer run GDP forecast basically somewhere between 1.8 and sub 3%. Again, very, very, very tight range. Unemployment for the same time period to 2028 and even in the longer run. I mean, they have unemployment rate essentially ticking flat to ticking down over the next several years, never exceeding 5%, and really being more in kind of that mid 4% unemployment range, which to their measure is fully employed. So, a lot of conversations. We listen to talk, I don't know. I don't listen to Jim Cramer anymore, but maybe Jim Cramer. A lot of talk about recession. We've got another report that we can talk about here as well, released by the Department of Labor, this came out, well, it was sequestered until 8:30 a.m. today, September 18th. Unemployment insurance weekly claims. And in this report, it says in the week ending September 13th, the advanced figure for seasonally adjusted initial claims was 231,000, a decrease of 33,000 from the previous week's revised level. The previous week's revised level was up by 1,000. The 4-week moving average was 240,000. And it's a lot. The unemployment rate, while is not exactly ticking up, job openings are declining. The sentiment is that there's less jobs available. There are some more layoffs happening. And if you look at previous recessions, unemployment rate can really stay very steady, and then all of a sudden it drops and we're in a recession. Mm-hmm. So there's not too many great leading indicators, early indicators of a recession besides maybe the yield curve, which has been flashing warning signs for quite some time. We've just never eventually ran into that recession. If you look at a lot of forecasters, the forecast for a recession is still relatively low. It's like kind of 20 to 40% depending on which given day and who you're asking. The Federal Reserve certainly doesn't see a recession, but a lot of people are really concerned about the state of the economy. And if you look again to this Michigan survey of consumers, there's a lot of people who are negative on the economy. So, Addison, I summarized a lot there. Where are we in today's economy? Are we getting ready to go into a recession? And is the Federal Reserve, did they hit the nail on the head? Are they right, or are they too slow? Are they behind the curve?
I don't necessarily know if we're in any different of a attitude, or should be in any different of an attitude than we were in moments of 2023 and 2024, where, in reading some of these articles before recording, if you look at where inflation was in 2022 and where we were able to cut it in 2024, it's pretty remarkable how we were able to really course correct in that time frame. And granted, 2 years didn't feel like a long time. It certainly did going through that, but it's remarkable to see the amount of changes that we made. And also, I remember writing about it on LinkedIn and being told that the view from my ivory tower was nice, that the United States economy was performing compared to the other I don't want to say the OECD, or maybe it's G7.
G7 kind of developed countries.
Yeah, how they were phrasing it, our economy rebounded significantly better than the others from that COVID shock.
Yeah, we all don't take vacation in July.
Well, he did that, yeah. But it was interesting to see that as we had those positive trends happening, the Fed was very much but we're still not there yet. And then now in 2025, when they've had some pretty serious job number revisions, the past few job reports, and we're starting to see some uptick with from the employment insurance with the Department of Labor. I'm kind of surprised that they went. I'm just kind of surprised that with this one, I don't want to say went full steam ahead, but it was we're going to do a cut, and we plan to do more cuts when we're now starting to enter this territory. And I think they even mentioned in the report of there's some uptick in inflation with these tariffs. And also, if we go full speed ahead with these, we don't know how that's going to go. That it's not for me to necessarily say it's a wrong decision. I just think that given how cautious they were in 2023 and 2024, when I felt like we did have some more positive trends, today I'm surprised that they reached a different conclusion.
Were you expecting, or not that you were expecting, because I'm sure you probably were expecting 25 basis points, but are you saying that we still have a good amount of inflation and we could have probably kept rates steady and to try to be a little bit more restrictive to tamp inflation down a little bit more?
I think it's something that was odd to, try and make sense of when we had the run up in inflation in 2022 and 2023 was, one of the things that we were constantly told was For example, a big contributor to inflation was, we were being told, was the supply chain issues. And was, how do we get people to work the supply chains, get people back to work? How do we get this manning at full capacity? And what's kind of at least been taught in plenty of college economic classes of like, the Fed's trying to either fix inflation or fix employment. You're in this weird situation of, okay, well, we need people to get back to work so we can lower inflation. Well, we're going to raise the rates. You're thinking, okay, well, if the whole goal is just getting people back to work, is this really an interest rate issue versus just how are we getting people to actually get into the supply chain and just get things running at full capacity? Where we're at now with inflation, I don't know if we can fully say that inflation is it's now with a different cause or potentially different cause via the tariffs. And I guess where I'm really surprised by and where I thought that they would have held things steady is just we need to wait and see what the full plan is here or what the full effect is. Because where we were in 2024, I would have thought that we were in more of a comfortable spot of this is just kind of how things are going to be.
Yeah.
Well, as now that we bring tariffs into this equation, I don't think we all fully know how this is going to, how they're going to actually implement these, but also how's this going to play out?
Yeah. Well, I think that what's tough is so far, there hasn't been a ton of inflation that's worked through the system that we can really be directly related to tariffs. I mean, there's been a few pieces, a few line items that's like, yeah, it's probably a little bit tariff here, a little bit tariff there. But the biggest contributor right now to like CPI inflation is shelter. Mm-hmm. And like we know, looking at all the private data, that rent growth has been negative really for the last year, really last several years, depending on which market you're looking at. Mm-hmm. But it's CPI because the way that they calculate owner's equivalent of rent and the rent of shelter is extremely lagged, and it has only shown positive growth throughout the last several years, which is completely different from what we're seeing in the private market data. Shelter is a third of CPI. And so if you were to strip out shelter, we'd be at 2% inflation. Mm. If you replaced, and Jay Parsons did this on his last Rent Roll podcast, if you replace the way that they calculate shelter for CPI with the private market trackers, inflation would be below 2%. It'd be like 1.8 to 1.9. And so I guess the question is, or where the Fed is the question the Fed is tasked with is, which is the bigger problem? Is it unemployment or is it price stability and inflation? And if you really look at the headline of 3% inflation, you could say, well, maybe it's inflation because unemployment is still really low. It's in the mid fours. But if you accept that inflation is lower than 3%, it's actually probably closer to 2 or in the mid twos. And we're starting to get all this data out that's showing that unemployment is coming up, and our unemployment claims are revised by 900,000, and the employment picture is starting to turn. And that and once that turns, it can go very quickly. Mm-hmm. The calculus is, let's do something measured that's not that big, that really kind of is, in a way, isn't consequential. Again, because if like 25 basis points is going to make or break you, I mean, you're kind of too far gone. I mean, like there's very small percentage of like deals or whatever that's like, oh, 25 basis points. Like if we would have been lost without those 25 basis points. Now, eventually, the 75 basis points will help, but it's not a full move to like accommodative monetary policy. You could argue that you're moving either from very, very restrictive to still being restrictive, or you're moving from, at best, to restrictive to neutral. But I don't think too many people would call the Fed funds rate today still accommodative. So yeah, I don't know if they're doing a bad job, but at the same time, looking at the SCP, it doesn't say that everything's perfect. They're basically saying we're going to make everything perfect. But in order to make the decision that they did, they would have to have acknowledged that, like, well, there's some risk for some downside. There's a risk of slowing down. There's a risk of slipping employment. Therefore, we need to take some action, lower the Fed's funds rate. And when we do that, we will then be able to realize this Goldilocks soft landing scenario of just very smooth glide to 2% and how they calculated inflation and 2-ish% GDP growth.
And quite frankly, I think in moments of 2024, I guess that to me is more so puzzling of, I think some of this stuff could have been done in 2024. Maybe not as drastic, but it seemed like at one point we were set up in 2024 of like, we can begin that process.
But to your early, and we kind of were. I mean, they did a 50 basis point decrease in 2024. And if you remember last year, this time, everyone was like, no, rates will be lower. Inflation is already slowing down. Like,
Yeah.
We're moving to a good spot because everyone's like 2020, survive till 2025. Rates are going to be lower. Deals will be done. Maybe we'll do some refinances. People, the market's just going to thaw and everything will be, nice and easy. Well, that wasn't the case. It was more confusing because it was like, not only is that not happening, there's this whole tariff regime. And basically, the idea is like, we're going to reshuffle and reshape the entire global trade order, how we think about trade, how we do international business, how the largest player in the economy of the United States interacts with all of our trading partners.
Yeah.
And so it's like, well, that just not only adds uncertainty, it adds volatility, and adds so much noise to the system. And we also haven't had really good analogs to compare tariffs in the modern economy. Like you have to go back 100 years, like to the Great Depression, at the turn of the century, or you have to go back to, the Gilded Age, to where we saw, tariffs at a similar level, and just the economy is so much different. So like we don't actually know what the effect is, other than, well, it's technically like a tax that technically we're supposed to be paying, but we don't know how it's all going to play out. But in reality, there was a lot more nuance than that. Some of the producers are paying it. Some of the importers the middlemen are paying it. Some of the importers are actually, or the receivers are actually paying it. So it's not, and some of the consumers are paying it. So it's not necessarily like hitting us where we thought it would hit us. But it's also, we don't know where the baseline is and how it's going to change. And so people are just throwing up their hands and saying, I can't plan. And maybe we are going to go into a recession. And I don't know what my cost of goods are going to be like. And since I can't plan, I'm not going to hire any more people. And if somebody quits, I'm not going to rehire because I don't know what the business environment is going to look like.
Well, and I also, in plenty of conversations, I don't like using a one-off story or, I heard it a few times, and this is going to happen nationwide or a trend because, either it does or it doesn't. And when it doesn't, it's like, okay, really, you based off that. But I want to say in the Chicago Tribune, they talked and highlighted some businesses in the city that, as soon as the election, they got the result of the election, they did their, bought immediately to get ahead of their supply.
Yeah, they front loaded. Yeah.
Well, they know they're running low on that inventory and they're going to have to re-up. And, there definitely is a price increase. It's not going to be backbreaking, but they know the next time when they have to re-up on that cost is going to go up. And so I am wondering if that was widespread enough, how many places are sort of like, okay, we forecasted ahead and got ahead.
So they got all the inventory beforehand, locked in the lower price, and now they're going to have to re-up at the higher price, and that's when it's going to
right
through.
And I don't want to say that that's a widespread thing. I don't know.
Yeah.
But I am wondering with these, just in this weird way with tariffs of the on again, off again, but also what happens a full year later, 2 years later as well.
Yeah, I think you're right. I think everyone is still at least waiting for, not confident that we've seen the whole story.
Right.
We've seen all the ramifications and what are the second and third tier effects. It was like you said, if somebody was able to buy all of their materials in the first quarter, which we saw, very low negative GDP in Q1, and it wasn't necessarily because of low growth. It was because people were buying stuff to front load, getting in front of the tariffs, and so now we have to re-up. Now I don't know how often, if it's like an every 6 month, 9 months, or every 1 month. I don't know if it's that infrequent or not. but we just don't know what those secondary effects. And also the rates are different from at that point. They've changed. It's hard to even keep track of kind of where we are. But I think that overhang is preventing people from making decisions and just giving that lack of confidence. And then, it gets getting to the psychology of having to continually get ahead of it and expecting prices to go up. So if people become in the habit of trying to time tariffs and trying to time the market and say, I'm going to load up on my goods now to get ahead of it, that turns into kind of could turn into an inflationary spike. I don't necessarily, I really don't think it is right now, but it certainly could be, and that'd be the concern.
Yeah. So that to me is the biggest, going back to my original point, hearing just some of that in the background and just looking back at other instances, that's why I was surprised yesterday things can happen. They can change their mind. But that's why I was kind of surprised with, albeit it was a small decrease, but I was surprised to actually hear it after what seemed like 3 years of some people saying, we're trending in the right direction. No movement, though.
Yeah.
So it's all right.
All right. We're just going to keep slogging along. So just looking into the future a little bit, this is the dot plot from the FOMC. So they ask, all of the different FOMC board members, the Fed governors, everybody that's sitting on the FOMC to kind of chart out where they think Fed funds rate should be. FOMC participants' assessment of appropriate monetary policy on the midpoint of target range or target levels for the federal funds rate. And so, we see a lot of consensus here at 3.5. Some, a little bit higher. We've got the outlier here all the way. I think we know who that is, all the way down just below 3%, kind of at 2.75. I guess the one consistency is if you look at an overall trend in the median, and there is a range. There's a 100 basis point range throughout the process. But it does tick lower. Now, the range basically moves from where it is today at, call it 4.25 down to 2.75. Eventually goes down to basically 3.75 to 2.5. Consensus of the Fed is the Fed funds rates are going to get lower, but not that much lower, it looks like. Kind of more of the same, which lines up again with the consensus for pretty much all of their projections are either just slightly, this is, PCE inflation kind of slowly ticking lower. It's too simple. It's nice, slow, gradual step down to 2% inflation. Unemployment rate basically staying where it is, kind of staying where it is. Again, GDP increasing a little bit, but not too much. It's just smooth sailing according to the Federal Reserve. And, I think where this has some people scratching their head. So on one hand, it doesn't look wrong. They're smart people, but I think people feel like we're just due for a recession. We owe one. We owe it to the economy gods. We haven't gone through enough pain. It feels like commercial real estate, we've been in a recession the last couple of years because the market's been frozen. There are people going through foreclosures, capital calls. It hasn't been easy in real estate. But it also, a lot of people have been essentially kind of bailed out, kicking the can down the road, extend and pretend. Zooming out, often a recession is needed for the businesses that deserve to fail, and the ones that deserve to survive can grow and get better. And as Darwinianism might be, it's a survival of the fittest. And we move so far away from that to where it's no one should experience any pain. And how could you have known that interest rates could go up? You poor thing. Everyone thought interest rates were going to be low. You don't deserve to lose your deal. And I'm the banker. I don't want to deal with it either. So we're just going to let you just keep that property for the next couple of years. But I don't think we're building a strong economy or a strong foundation if that's what we're building on top of. You have a sense of do we deserve a little bit of pain, or have we gone through enough? And the economy just doesn't look the same way it has in previous cycles. And call it a recession, call it not a recession. We've been gone through something, and it's just not as orderly and uniform as it has been in the past.
So I guess two thoughts on that. When it comes to being due for a recession, sometimes I wonder how much of it is due specifically for a recession, or within the last 5 or so years, we've had so many shocks to the system that have not really, like, I don't want to diminish the effect that COVID had, but we did have a strong rebound, and it wasn't like, it didn't just bottom out the way, or I shouldn't say bottom out, but I don't think it was like as prolonged. And I think when you go with COVID
but is that a money printer go burr, scenario, or is that just the economy is just so damn good and was so damn strong?
I mean, I hate to be a little bit of both person. Yeah, I think both could very well be
probably right.
Could very well be the case, but I think when you have COVID happen, and then after that you have inflation, kind of just the overall uncertainty regarding. I mean, I do remember now. I think people forget about it, and kind of the state of amnesia, but. The Ukraine-Russia war, when that was taking off, was a big deal in 2022.
Yeah.
And how that was going to affect global supply chains, and on top of all of the sanctions that were going on around the world and trying to combat that. And
we bombed Iran like a month and a half ago, Addison.
Yeah. And so you think about enough events that have happened or enough shocks to the system where also enough people thought, like, all right, this is it. And it didn't happen, or it wasn't as bad as people thought. That I almost wonder how much of that is, are we really due for a recession, or it's just we've had enough shocks to the system. At some point, it's going to happen. It's going to have to happen.
Yeah.
I wonder how much of it is that.
Like we just didn't, it wasn't one shock. We've just had multiple shocks that have disrupted things, thrown things off, but those individual circumstances haven't been enough to bring the whole economy down all at the same time. Is that kind of what you're saying?
I wonder that, and to even bring it to a micro level with real estate, something that did help is as much as interest rates moving up, really, things did slow down. I
feel like we've been in a recession for real estate for the last couple of years.
But even then, so many new properties being built by merchant developers are like, we have to sell. This is not a part of our business plan is to not hold any of this. It has to happen. And so I wonder if there's enough of those situations, not just in real estate, but across the board, that it kind of softened what could have been. Whereas if this happened in, say, 2016 or whatever, it feels a lot worse, or it looks a lot worse.
Yeah.
As for the pain that I guess needs to be felt or should be felt, something that I have wondered kind of at the height of inflation and just where we're at now is there's certain costs that have gone up, and I wonder at what point they stay that way and public psyche just kind of realizes this is what this is going to cost now. This is what wages are, or just costs of certain materials. It's run up. It's going to stay that way, and we're going to need to kind of like what I said earlier about the home buying situation, just broader economy. Like, we kept waiting for things to adjust, and they're just here. We're stuck here.
Yeah. It's kind of like, all right.
And because we've now adjusted,
do it or don't do it.
Yeah, and because now we've adjusted, if it goes down, if prices go down or rates go down.
Well, I think that's I feel that for a lot of investors I'll talk to, or multifamily operators who are like, we're only going to buy, like a 6.5 cap rate deal. We're only going to buy, we're trying to buy A class, but it's got to be a 6 cap and up. And your reaction says it all. It's like where you're not buying deals. You're not participating. That's fine. You don't like the way the risk in the market. You think it's too risky. The timing's not right. You can't make sense of it. But if you're just not going to participate at this point. You can't say like those deals just don't exist in any sort of volume. Not that like a couple don't exist somewhere, but it's fewer and far between. Or you come to the conclusion that this is the market. cap rates are probably not going to blow out anymore. Maybe they move up a little bit, here and there, but there's enough. I mean, we've seen there's enough buyers in the market that are willing to transact at high prices and relatively low cap rates. And so there's something would really have to happen for that floor to fall out, because there's enough anticipation for the long run, or there's enough capital in the system to make deals happen. Is that what you're seeing, or
so when the CBRE Midwest Multifamily Group had a presentation and just kind of I don't want to say state of the market or state of the markets around this time last year, CBRE's head of equity research had said there are so many institutional players that are kind of in the wait and see mode of like, we're pulling back, we're still going to monitor what's going on, but we're likely out just because, again, still uncertainty. And at that point, they're heading into an election. They don't know how things are going to go. So much uncertainty.
I get it, but I think that's the silliest thing.
I do as well. But what his, I guess, recommendation or their take on the environment then was, because the institutional groups are out and it's relatively high interest rates, for those that are non-institutional groups or don't have the institutional equity backing, it's a great opportunity for you to get into a really good asset class that otherwise, when they adjust and get back into the market, you're going to be moving down or down in vintage.
Yeah.
Like, if you're playing it, you're going to be in a sandbox now that's way different than if they get involved again. So if you can find something that's, if you've primarily been a 90s or 2000s group, because that's where your pricing is at, and you see something in the 2010s that you can make sense of in a market you like, do it now.
Go more institutional if you can do it.
Right. And so
institutional grade, quality, bigger, nicer, newer.
So to me, I think it's a little, looking back on it now, it's a little naive to think, wow, some deals that seemed out of touch and out of range 2 years ago are now, I don't want to say asset prices have bottomed out, but I mean, now they're sensible. It is kind of naive to think that like people that are in those deals or in other deals are like, yeah, they've bottomed out and it's a problem for us. And that's why I don't want to deploy more right now. So it's just interesting to me to think that, there's that push of you have a really good shot at these deals, you need to move on it. But at the same time, it's like, why do you think we have access to that type of pricing right now?
Yeah.
So that's kind of what I'm seeing a lot of.
The types of deals that, like Flats to Stones Crossing, a deal we're going to be closing on here in about 10 days or so. I can't imagine we would have been able to buy a deal like that if it wasn't for this type of environment of less competition.
Yeah.
I mean, because, when in the past, pre-COVID, when we've looked at like brand new deals, they were just so far away from the purchase price from a return standpoint. It's like there's no way we could accept those low of returns. And it was always a question of, who's buying this? And it's some institution, it's some, large group that's like clipping a coupon of 4%. And we're like, well, we can't buy a deal and just clip a 4% coupon. We can't raise the money to do that. It's just, it's not enough meat on the bone for anybody in that type of deal. Mm-hmm. But we're able to buy them at cap rates that make sense, that are, mid fives, like 5.5 cap rate based on Flats and Stones Crossing on their, kind of T3. That deal would be sub 5 easy. Back in 2022, Q first half, H1 2022, it would be trading, near a 4 cap, or a 4.5 cap at the absolute highest. And, I don't think Federal Reserve doesn't think, and I don't think we're going to go to the same rate environment that we went back then. But we're already seeing some A-class deals trade for 5 caps, for 4.75 cap rates. And so we know that that's kind of the potential direction of travel, assuming that interest rates stay where they are, or if they tick any degree lower, we're kind of going to be within this band. And certainly not seeing really any evidence, especially in the Midwest, in halfway good markets, halfway good deals, that we're going to be in a mid 6 cap rate environment, unless it's an older value add deal. There's a lot of hair on it, a lot of meat on the bone.
And I think, that type of situation is is exactly takes advantage exactly of what the CBRE head of equity research was saying of like, even if cap rates don't really move, there's enough uncertainty or enough going on that some institutional players have been on the sidelines. And so even without cap rate movement, it's just you have a different level of buyer where all of a sudden this stuff is becoming more accessible. And so I wonder, kind of with those deals hitting the market and with the recent news with interest rates, I'm wondering how long is that environment going to stay?
Yeah. Yeah. We'll see. It changes every day. Seems like it changes every 3 weeks. We've talked a lot about sentiment, people thinking one thing about the market, maybe different from reality. The survey of consumers from the University of Michigan, what came out specifically right here, we have their trade policy and expected consumer spending. This is interesting because if we go through, there's a lot of interesting takeaways. All consumers. So it breaks out the age range, which there's some interesting differences. But those who will spend as usual, and so these responses are May through July 2025. All consumers will spend as usual. Only 24% of consumers are going to spend as usual. 58% will cut back spending, and 13% will stop. Now, there's some deviation between, the older you are, typically you're going to be in a better income monetary situation. So the older you are, you're more willing to spend a little bit more, like we're the 18 to 44 age cohort. 22% are going to spend as usual, where 65 and older, 31 are going to spend as usual. Income, the lower third, 18% are going to spend as usual versus 31 that are going to spend as upper third, 31% are going to spend as usual. Again, pretty much the vast majority, everyone is saying we got to cut back a little bit. We've got to cut back. That's good for inflation. That's not necessarily good for a potential recession. Now, going down even deeper, I just thought fascinating. Inflation expectations. It breaks out the cohorts that said they were either going to spend as usual, cut back, or stop. Of those who are going to stop spending, which I don't know how you stop spending, but like you're just absolutely going to stop spending. They believe inflation expectations for the next year, inflation is going to be at 9.8%. We were just talking earlier how in reality it's probably 2% in reality. CPI says it's 3%. They're saying it's going to be more than 3x. It is not even in reality. I mean, 5x of what it probably is in reality. Those who say we're going to cut back, which is the majority of respondents in the survey, think that inflation in 1 year is going to be 5.4%, which is double what inflation really is today, a little bit less than double, according to CPI. We'll spend as usual. They're actually right on the dot of what CPI says inflation is at 2.9%. They believe that it's going to drop down. All of the cohorts think it's going to be a little bit less inflation over the next 5 to 10 years. But again, the will stop spending folks, they think we're going to have 9% inflation for the next 5 to 10 years. And then of those groups, those expecting unemployment to rise next year, unsurprisingly, the will stop folks, 79% of them think that unemployment is going to rise next year. 65% for those who think that they're going to cut back on spending. Only 40% or 39% of those who are going to spend as usual think unemployment is going to rise next year. It doesn't necessarily bode well for those inflation expectations, because as we mentioned, if you think that things are going to be more expensive, you will front load those purchases, just like we saw in Q1 of this year, those businesses, just like you were describing earlier, Addison, of like, hey, it's going to be more expensive. Let's buy as much as we can right now. And it leads to this like binge buying, because it's like, I got to get all now because the price is going to go up. I just got to hoard a bunch of stuff right now. And it becomes lumpy. And again, it can really start throwing off some of these inflation numbers. So this is talking about, do you favor advance buying? And more people favor advance buying today, 30%, yes, buy now, than in 1979, 1981, or in 2022. That's wild to me.
So I was only alive for one of those periods prior to 2025 where they can explain that. So I'm sure anybody that's listening to this that was around in 79 or 81 can very easily correct me. I don't have a feel for what the economic situation was there. I think the increase, even from just from 2022, I think a lot of that has to be tariff infused. And maybe people that just don't have an understanding of it, or there's been so much hype around it.
You think in 2025?
Then in 2025, I'm wondering that uptick has less to do with the overall economy and more of just people have said a bunch of stuff about tariffs, and you feel like you got to do something now because of
people talking about milk and eggs.
Right. So I wonder for that specific jump, I'm wondering if that's the case. And I almost feel like that is the case just based on just how things get talked about. But
if you would ask, we have to go back and we can look at this survey from even in years, prior to the pandemic, prior to COVID, in the mid, 2010s, call it 2017, 2018, when we almost had no inflation. You could easily find people that say, no, actually inflation's about 10%.
Oh yeah. And
there was a lot of that. I'm like, I know what you're saying, because where they're coming from is like, well, we're doing all this quantitative easing, we're printing all this money, things are more expensive. Like, you just don't see it. They're reporting fake numbers. Inflation's actually at 10%.
Going up to the initial, the first section that we were looking at, I think we're always reading reports and we're always monitoring stuff that the Fed's doing. And so we kind of live in this world. And I'm sure people that are listening to this and have heard my rambling think even I probably don't have an understanding of it. But in a lot of ways, I think we underestimate how people, one, how much they even care or check up on economic news, and also like where they're hearing it. Because
what are you talking about?
Well,
everyone subscribed to the Great Report, Addison.
I'm just thinking of like when we were talking before recording of the survey that Trepp read around this time last year of people that thought 50% of the survey thought that we were at all-time highs in unemployment, and it's like it's quite damn near quite the opposite.
So this is like the vibe session all over again. It's like just the vibes aren't right.
I don't necessarily want to go that far, but I am wondering truly where majority of the people do get their economic news or feelings, because I remember.
Where do you think?
Quite frankly, I think they get it from whatever political podcast they listen to. If they do.
I think it might be being generous that you think that the majority of people are listening to political podcasts.
Well,
which I think a lot do.
I don't necessarily think it has to be political podcasts, but I think where news media is right now, I think people are going, we've created a large environment of, if you don't like what you hear, there's somewhere where you can go to
You're
find
just
going to
go get the narrative that aligns with your worldview.
But
you think how much? You think a lot of it's? Do you think? I have to get some numbers on podcast uptake, but I'm assuming that social media is playing a big role also, or is this like is just Gen Z off social media now and only doing podcasts?
No, I think social media plays an outsized. Yeah, I still think social media plays a pretty outsized role in overall sentiment of economic issues and, quite frankly, other issues. But I remember going back to kind of around the same time frame last year, just before the election, and was meeting a friend downtown Indianapolis, and it was the day of the big Taylor Swift tour, and downtown was packed.
Yeah,
and I get it; she's a big draw, but those tickets were. I don't think the cheapest ticket was what, $1,200.
I don't think.
If that,
as someone who was basically in the nosebleed seat, and I paid a lot more than $1,200 for the ticket, unfortunately.
And so
they were expensive.
As I said earlier, I don't want to pick one event, but it's weird to hear at that time. It was weird to hear people say like, we can't afford gas, we can't afford eggs, and that you're downtown Indianapolis and it's like people are paying nosebleed seats for like $1,500 for this concert.
Well, and part of that could just be the bifurcation of the stratification of the economy. The wealthy are getting wealthier because they're allocated assets and assets have done well versus folks, if not allocated assets, probably haven't been able to keep up. Wages have been outpacing inflation recently, but over the last couple decades, not as much. And purchasing power has been eroded from inflation and all that.
Not just to, I guess, double down on that concert, but I think of how many people have mentioned, went on this vacation in 2024, or
people are still spending money.
And that was one to me that was always like, okay, I'm told the economy's bad.
Mm-hmm. Can't be that bad.
But the actual actions that are happening on would not indicate that you're worried about if the next paycheck is going to come.
Yeah. And as anecdotal as that is, because it's a complete anecdote, right? It could be a fluke. Some of those like flashes, when you see something like that, it can be much more accurate and leading indicator than any economic report that you're going to see. I mean, in COVID, I remember going out to dinner when like lockdowns were like it was on the edge of like it was post lockdown, but everyone was
worried about it happening.
Kind of worried, kind of worried about it. Then we went out to dinner. I'm like, this place is packed.
Yeah,
I'm like, the parking lot's full. This restaurant is full. I'm like, people have money and they're spending it and they're going out, and this economy is on fire. Now it was too much fire because the money printer was going burr and the helicopters were flying around dumping money out of the helicopters everywhere. So there was so much money sloshing around the system that was much more in line with than what the numbers were showing at that point in time. And you're right. I mean, there was a lot of wealth that was sloshing around. There still is a good amount of wealth. There's psychology that will say people just keep spending money until they don't have the money. And so how much of it also was, it's like, well, we're used to spending a lot. Maybe we're not making as much money, but, we're still in the habit of, we haven't actually made that adjustment to our budget.
Well, and where part of that, I guess, confusion or disconnect for me came was, my family has a lake house up in the northwest corner of Illinois, near Iowa and Wisconsin. And that summer of 2022, when inflation really ticked up, everybody was like, you couldn't turn on the news without hearing about how bad inflation was.
Mm-hmm.
I remember at the end of the summer asking my dad, like, how's the crowd up there? How was it? And he was like, the lake was pretty dead all summer. And he was like, it's because a lot of people driving, if you're from the Chicago area and it's a 2 or 3 hour drive to get up there. How many, given how high gas prices are going, on top of gas for the boat,
for everything else,
how many of those people just said,
Not
that summer I'm pulling back? So you see that in 2022, and then in 2024,
the people with lake houses are pulling back from the driving up for their gas.
I thought that too, but I feel like a big part of growing up is realizing that just because people have something doesn't mean that they can afford it and pay it all cash.
That is true.
But you take a look at that in 2022 to then go to 2024 where people are like, we went here for spring break and then we did this for the summer. But the price of eggs, it's like,
I know.
Okay.
Yeah.
The math isn't mathing.
No. And it's the price of eggs, it's the price of milk, and it's everyone's personal, experience. And it's hard to say. And it feels like we just don't have the words or the descriptions or the labels to describe what's been going on in the economy. We have, recession, we have inflation, stagflation, which is kind of it's called soft stagflation, but we're basically been sort of a soft stagflationary-ish environment, I think, for a little while, going in and out of it, of a little bit inflation here, but kind of just sluggish growth. But that term hadn't really been invented or described until the 1970s, and sometimes I think taking a step back and saying modern economics is pretty new. It's really kind of less than 100 years old. It's been less than 100 years since we've actually been like off the gold standard. The Federal Reserve is like a little bit older than 100 years old. So like I'm not saying that it's all an experiment, but we're still kind of in this phase of like we only have so much history. I mean, the expansion of the federal government in the '60s. You know, Thinking that that's a relatively newer way of doing business. I mean, the Department of Education was stood up in like the mid '80s, and we live in the world where it's like we think that these institutions have been around forever, but just the economic paradigm that we're living in is still relatively new, and it's like it just because it doesn't fit the standard definition of a recession doesn't mean that things are perfect and smooth sailing.
If you want even a newer example of that,
Yeah.
I want to say it was like pre-first Trump administration. It was still the belief of like if unemployment ever gets below 5%, like you can't like at 5%, like that everybody has a job at 5. Like it can't happen.
Exactly. Yeah,
And
we've been below.
We've been
5.
under it for
Exactly. Yeah. I mean, modern monetary theory kind of got like a shot on the last cycle of like, hey, look, we can print money. If it doesn't create inflation, print it, spend it, all good. And if you see some inflation, then bump up a couple taxes here and there. You're fine. Now, COVID, I think we had a reminder post-COVID, because we did print so much money. I think everyone kind of thought that might have been the case, and went back to the great financial crisis, and we're like, oh, we could have made this smoother for everybody if we had gone in even heavier than we did. So let's go in heavy. Let's pump the system full of money. Basically the whole economy turned off, so it's like we're just filling a hole. But the result was we had a little bit of inflation. Now, supply chains certainly contributed to that. Increasing the money supply by like 2 or 3x also probably had something to do with it also. I think we're still learning all these lessons, and we're relying on a committee, the FOMC, who are mere mortals. They're people, and I think they're smart people, but I don't think anybody knows. But we've got one group that's going to make the decision on what the cost of money is going to be, and they're using data that is largely not accurate. Not to go back to that as we do every week.
No, but that's a calming way of thinking of things.
You can't control it. Just don't worry about it. It's fine. It's all good. Smoother heads will prevail. They know. They're smart people.
Yeah. I mean, that, and also that is something that has been really, it's been interesting to read, because post-COVID and after that round of stimulus, people did talk about that a lot, of what worked and didn't work in that round, and also comparing it to the great financial crisis. And that did seem to be, I don't want to say the prevailing thought, but it wasn't all that uncommon to hear people say, like, we probably would have been better off if we did a lot of these things in 2008, 2009. Mm-hmm.
Yeah, like lessons learned, and yeah.
But, I mean, I was a lot younger when the great financial crisis happened, but I guess something that is really hard for me to wrap my head around is with COVID is a sense of like, okay, there's certain functions of the economy we need to shut off because it was deemed a public health risk. And as soon as we get this virus under control, in all hopes or in all seriousness, you'd think that would come back. So you need some like pumping money into to the economy and giving money to people of like, no, still go to, well, I should say still go to the movies, but still spend as you were going to.
Yeah.
It's hard for me to see how that would have necessarily like played out with how the great financial crisis was, because it was like a 2 or 3 year period of like just high unemployment. Mm-hmm. That economy was not great. And so how long were we going to have to pump money into the economy to give people money to spend while not having any like better job prospects in a 6 to 12 month horizon?
Yeah, and again, it's like who are you pumping the money to? Is it done in the form of stimulus checks? Or that was one of the lessons learned, is that and the criticism is that in the great financial crisis, like they did print a bunch, they did hand a bunch of money, but they just gave it to some banks. There was TARP. They basically were like, Bank of America, here's a big, you take it. You don't have a choice. Take this money. We're going to give you these grants, and they just spit out money all these institutions who were the ones that maybe caused a lot of the problems. And they got bailed out, and essentially everyone who was just working in the economy, normal person, got completely hosed. And so this round, they were like, well, let's hook everybody up with some stimulus checks, in the sense that like that may be as impactful or more, and relatively marginal in terms of like a budget. It's like, well, we could do this for just a couple $100 million versus $1 trillion. Let's just give everybody a check. And Donald Trump's like, I can put my name on it, and everyone's going to think it's great. And it was certainly fine for the multifamily because everyone could pay rent. Never had collection rates so high, and occupancy, went to the roof. So it's a lesson learned, but I again, and I think that other than the inflationary impact, and it's like, we're going to give you a $400 check today, but your purchasing power over the next couple of years is going to decrease by thousands of dollars. So it's like a little bit of help today, but we're actually going to have an invisible tax over the next couple of years, because we're going to, we're giving you debt. We're giving you this cash as we're issuing bonds. And if we're taking those Federal Reserve notes and sending them over to you to be able to hand to your landlord, who's going to hand them back to the bank. And it's going to kind of come full circle. So it's, I don't know. I don't want a recession to be horrible for everybody. I do feel as though people who made bad business decisions should not be rewarded, and continue to just be able to make bad business decisions. It creates a moral hazard, moral failure, and I think we create a more fragile overall economy that can cause more economic pain and hardship to everyday people in the long run.
You think about how it ties into real estate cycles, like that does need to happen. Right? It
needs to be a cycle. You have to have you can't upend the cycle. Just average it out. It's not good for anything.
Yeah.
It doesn't work. Addison, we're kind of like out of time. There's things I want to talk to you about underwriting. We talked a little bit about it, but what have you learned? You came on the Great Capital in the middle of the pandemic, 2021, right? You did your internship summer of 21?
Yep.
What's changed since then?
I mean, all sorts of things. I think from my own personal career trajectory and day-to-day, I don't want to say operations, but just kind of a day-to-day view, I think how much I worry about or think about when I underwrite deals has changed a lot, not just because of the macro environment, but just because of Great Capital as a company. When I came on in 2021 and into 2022, when we had third-party management, it was just sort of like, well, I mean, this is how things cost, and you thought of things simply as a matter of per unit. And sadly, without having hands-on experience and a ton of prior knowledge, all you can really do is go off of internet guides that tell you payroll should never be more than $1,200 a unit, and until you start getting into the operations, realizing that like you can't always conceptually rely on that. So
just being closer to the actual operations and the management just has shown you a lot of taking you out of the spreadsheets and shows you where kind of the rubber meets the road and the reality of how these assets are operated.
Right. So I would say for particularly on the expense side, how things have changed a lot from 2021 to where we are today is there aren't, aside from maybe insurance, there aren't many things that I worry about on a per unit cost, because you can think about how things are budgeted for. And there's so many different ways where you can be detailed and really get into the weeds of what you'd plan for moving forward, that it's almost like your abstract per unit cost doesn't, it's not to say it doesn't matter, but like that can't be your primary thought.
Yeah.
Like it's just not realistic to say we have to keep repairs and maintenance to $400 a unit. Like I can't, it's hard to think that I was underwriting that way or even thinking that way. And then also going to the rent growth side, I think from 2021 and 2022,
it's changed a little bit.
Not just the level of rent growth, but I think there's always sort of a confidence of like, okay, you're below market, you'll just get back up to market. And now it's getting significantly more detailed as, okay, what truly what does our property have and what does it not have? And then going into every comp around and figuring out like, okay, forget the market, but what is the real growth for this and where's my actual movement? And it's allowed me, and I think just us as a whole, to be more confident, not just in the deals that we say yes to, but more importantly, the deals we say no to.
Yeah.
So I think those have probably been the biggest changes, is just knowing how things operate, because we're seeing it now and we're seeing it clearer than we were in 2021 and 2022. But I also feel like through having a better sense of how these properties run, almost having a comfortability of just knowing, like, on my underwriting around projections, like we are going to be wrong in some way. Mm-hmm. Expense growth isn't always going to be a flat 3% or a flat 4%. There's going to be variability. There's going to be variability in rent growth. There's going to be variability in, like what I had mentioned with lease termination fees. More so getting comfortable just like, okay, but if we do miss the mark, how and to what degree?
Yeah.
I'm okay if going through a repairs and maintenance, all the GLs, and thinking, okay, but these particular instances at the property, these are all things that they couldn't have budgeted for, we couldn't have budgeted for. It's really hard to predict.
Yeah. That's where you build in contingencies.
Right. And so I think that's probably, to kind of sum that up, the biggest is just knowing how the business operates, what you can control, what you can't control, and then building business plans off of that. And then I also think the best development to come out of probably this 2023, 2024, 2025 period, not just honing in on operations, but really having convictions on markets and understanding that, like, as everybody jokes, like the stock market just only goes up.
Yeah.
Knowing that, like, no, that's not always going to be the case. And I mean, you obviously understand that, but I think 2021 and 2022 gave a lot of people that thought it can only go up. And those are the people that are really happy about SOFR coming down.
Yeah.
But yeah, I would say just moving forward, I think that was the big adjustment, a much needed adjustment internally for me, is just like really honing in on the markets and almost, again, not really the markets you're saying yes to, but knowing what markets where you're going to face an uphill battle and it's not worth it.
Yeah. Yeah. It's much easier to flow down with the current than swimming against it.
So yeah, I would say that. And then also, I think from when I was on in November 2022 and where interest rates had moved, there was always this, well, if interest rates move here, and these are where the cap rates are eventually supposed to go to. And now I feel like we're at a point where, like, okay, the cap rates are starting to get to where we need to go. But there's just some assets where it's like, I think they're always going to buck the trend.
Yeah. Yeah. There's been some surprising deals that surprised us to, lower cap rates than we would have really thought. And occasionally, I mean, there'll be some that'll be higher, trade at a big discount. But those are the deals that, that there's really no bid on. So just kind of prices keep going down.
Well, and also in this environment, exit cap rates, I think, have played more of a role in a good way.
Yeah.
I think 2021 and early 2022 allowed for a lot of people to just kind of say, like, well, this is where cap rates are going to be. And now I think there's the amount of deals I've seen come on the market that have been really surprising to me are deals where you have to do a value add. There's really no way around it.
Mm-hmm. So you need to add revenue to get your NOI up to hit that number. But it's a big ask of, can you hit that number? Can you get that rent increase? You're going to spend the money. It sounds like a good equation. We'll spend $10,000, get a $200 a month increase, but is it going to cost you $15,000 or $20,000? But if you can only actually get a $500 or $50 bump, the math stops working.
Well, and to add some clarity of what I was kind of trying to elaborate on with who's in the market and who's not, some of those deals where your exit caps are so high, you then have to think of, okay, well, for you to make this work, you either have to find a way to get a line of credit, which, depending on your financing route, it's not going to happen. You have to be comfortable enough.
A line of credit on the acquisition
for your rehab. Yeah.
Yeah. Are banks offering that? I don't think we've asked for one for a while, but I'm curious if anyone's throwing it out there for you. Use the line of credit.
I mean, because we've been going agency, it's kind of that's just not going to happen.
Haven't crossed the bridge in a while. But that's how we used to do a lot of all of our deals. We would get a line of credit for the rehab. We would get a bridge loan. We get a line of credit for the rehab, and then we roll it into a permanent. We do the work over 6 to 9 months. Roll it into a permanent HUD 223F loan that fixed the rate for 35 years. It's great. Well, and HUD would basically take out the whole line of credit and the first loan, and a lot of the fees too.
But now where the market is today, if you think of either where the returns are going to be on a lot of these deals, if you go the agency route, which in a lot of cases is the most advantageous, you have to go agency, but then you have to find a way to fund that. You have to find a way to fund that rehab yourself, and it puts you in a return profile.
More equity means returns are going to go down.
And so in that return profile, it's like, well, it's not for groups like us. It's for these institutional groups. They're not in the market right now, or at least not in this market.
Not in the market, and often not always, but often they're not. They don't have the appetite for that kind of risk, that kind of project.
Right.
They want something new and shiny and stable.
So I can't emphasize enough the opportunity that's out there is it's great.
Yeah.
Unfortunately, it's just are all parties aligned to really attack it?
Yeah. And the entry point's hard to find also, because sellers have certain ideas where pricing should be and what works for us. It's tough. It's tough to find.
It's not 2021 anymore.
It's not 2021 anymore. Well, Addison, you'll have to come back on the Gray Report. It's a great episode. Thank you very much.
Thank you for having me.
Absolutely. Make sure you subscribe to the Gray Capital YouTube channel. You'll be able to get episodes like this. You're going to be notified, especially if you hit that bell icon. And again, as I mentioned before, the Gray Capital newsletter, the Gray Report, it's the best multifamily newsletter on the market, but it's for free. GrayCapitalLLC.com/newsletter. It's packed full of all the reports that we went over today, all these things, and like 10 more. And sometimes there's even more on there, but it's packed full of stuff of everything you need to see, nothing you really don't need to see. It's highly curated, summarized to where it's like you can get pretty much the full lowdown and be up to speed, highly effective at your job, whether you're an investor, you're working for a multifamily shop, you're working in property management, you're just curious about the space. You're going to be a high impact player armed with this kind of knowledge. And everyone's going to be like, how do you do this? And you're just going to say, I was subscribed to the Gray Report newsletter. And they'll be like, how do I sign up? And you can say, GrayCapitalLLC.com/newsletter. Thanks again for Addison to coming on the show. I'm sure you'll be back on soon. Stay smart out there, everyone. Make some good investing decisions. We'll catch you on the next episode of the Gray Report.